Welcome to the debate. Today, we're digging into a really fascinating and timely economic topic, this anticipated tax refund surge, projected for early 2026. This follows the enactment of President Trump's One Big Beautiful Bill, or OBB as it's called. Our central question, really, is whether this expected influx, this money coming back to people, represents a genuine and, significant economic stimulus for Americans delivering broad, tangible benefits, or, on the other hand, is it primarily a temporary thing, maybe an accounting-driven correction with potentially misleading long-term implications, for how people see it and how the economy behaves. I'll be making the case that this surge will provide a substantial economic boost and, importantly, direct relief for millions.
And I'll be offering the counter perspective. Well, yes, larger refunds are indeed on the horizon for 2026. I think their character is more of a one-time adjustment, almost an artifact of legislative timing, really. And the economic effects, well, they're ultimately temporary and maybe not indicative of a sustained stimulus in the way we usually think about it.
Right, so the One Big Beautiful Bill, it officially became law back in July 2025, but, and this is key, it was made effective retroactively to January 1st, 2025. That detail is why it's poised to deliver a really significant financial boost in early 2026. The initial estimates, they're quite compelling. We're looking at an average tax refund projected around $3,743. Yeah, that's nearly $500 more than the previous year. That translates into a pretty substantial 15% jump for the average taxpayer. Now, when we consider this across about 117 million refunds, we're talking billions of dollars directly entering the economy in a pretty concentrated period. The source material actually projects this could boost our GDP by approximately 0.5% in the first quarter of 2026 alone.
Okay.
And this isn't just some abstract number. The source frames this really well, I think, calling it a mini stimulus check and even a sugar rush for the economy. Why? Because, people genuinely tend to spend these refunds. They often direct this, sudden influx towards immediate things, restaurants, retail purchases, maybe that vacation they put off, or just as importantly, paying down high-interest debt. It effectively injects crucial disposable income directly back into the economic bloodstream. This isn't just theory, it's a demonstrable impact on aggregate demand. And the benefits really do seem to extend across a wide demographic spectrum. Several specific groups are set to gain quite significantly. Take seniors, anyone 65 and older. They'll receive an extra standard deduction, $6,000 for singles, $12,000 for married couples filing jointly. That's critical relief, especially for those on fixed incomes.
Right.
Then you've got our hardworking tipped employees. The OBB allows them to deduct up to $25,000 in tips from their taxable income. That's a huge relief for many in the service industry, particularly those whose total income falls below certain thresholds, making sure the relief targets those who need it most. Overtime workers, they also see a substantial change. Up to $12,500 of their overtime pay for singles, or double that, $25,000 for married couples, becomes entirely tax-free for federal income tax.
Okay.
And for residents of high-tax states, they'll find considerable relief too. The cap on the state and local tax deduction, the SALT deduction, jumps significantly from $10,000 all the way up to $40,000. Parents with kids, they aren't left out either. They benefit from an increase in the child tax credit from $2,000 to $2,200 per child. Even car buyers get a bit of a boost. They can deduct interest on auto loans up to $10,000 annually for new U.S. assembled cars, though there are income caps, typically designed to benefit middle-income households. So, this comprehensive array of benefits, it translates directly into tangible financial relief and increased purchasing power across a really broad spectrum of the American population. It leads, I'd argue, to a demonstrable improvement in financial well-being.
I appreciate you framing the immediate financial relief like that. And look, there's no doubt an increase in refunds for 2026 is anticipated. But my perspective really diverges significantly on its true character and, maybe more importantly, its long-term implications. I believe its nature is primarily that of a temporary, accounting-driven phenomenon. It's not really a sustained economic stimulus. Let's be very clear. A tax refund fundamentally just signifies that an individual has overpaid their taxes through the year, and the IRS is simply giving that excess back.
Well, yes, technically.
And the source material itself is quite explicit here. It states that the 2026 refunds are, and I quote, artificially inflated. Now, that's a crucial distinction, I think, that we can't just gloss over. This artificial inflation happened because the OBB passed in July 2025. So what that meant practically was for most of the 2025 tax year, payroll systems all over the country just kept withholding taxes under the old higher rules. But the new lower tax rules, those were retroactively applied to the entire 2025 tax year, backdated all the way to January 1st.
Right, the retroactive part is unusual.
Exactly. So consequently, millions of people unwittingly overpaid their taxes throughout 2025. The larger refund they'll get in early 2026 is therefore simply the return of this built-up overpayment. It's not some fresh infusion of new government funds or a newly generated economic benefit. It's effectively delayed payment of money that was always theirs to begin with. And the source also provides a really crucial warning or caveat regarding 2027 that reinforces this point. Payroll systems will by 2026 have fully adjusted. They'll reflect the new lower withholding rules set by the OBB. This means Americans will start seeing higher take-home pay throughout 2026, right there in their regular paychecks. So as a direct result, when taxes are filed in 2027 for the 2026 tax year, refunds are expected to, quote, shrink back down or normalize significantly. Why?
Because individuals will have already received their tax savings up front in their paychecks, rather than waiting for a big lump sum refund. Therefore, this sugar rush for the economy in early 2026, while yes, it's a real event in that moment, it's just not indicative of a long-term sustained increase in annual tax refunds or permanent boost in disposable income beyond what was already rightfully due to them. It's really a one-off effect, kind of an anomaly in the tax cycle. Core debate.
Okay, while I understand your point about the, let's call it the accounting origin, I'd argue that the economic outcome is what truly matters here. Can we really dismiss the stimulus effect just because the money was technically owed rather than, say, newly printed by the government? The mechanism, the overpayment, it doesn't diminish the fact that an average of $500 more per refund distributed to 117 million Americans, that represents billions of dollars directly entering the economy in a very concentrated period.
But is the source irrelevant?
Well, the source material clearly states this money is typically spent. It functions as a real infusion of disposable income that drives economic activity, much like a traditional stimulus payment would. It's crucial, I think, to distinguish between the source of the money and its behavioral impact. A lump sum, even if it's technically an overpayment return, often triggers a different psychological response than just a marginal increase in your weekly take-home pay. People seem more likely to allocate a sudden, significant cash influx to discretionary spending or maybe larger purchases, a new wash machine, fixing the roof, maybe a down payment on something bigger. That creates a concentrated surge in demand that is distinct from a gradual, incremental increase in purchasing power spread over 12 months. This concentrated spending, well, that's precisely what we often define as a stimulus in terms of immediate economic activity and its impact.
I appreciate you focusing on the behavioral impact. And I agree, getting a lump sum can certainly lead to different spending patterns than seeing a bit extra in each paycheck. However, I still remain unconvinced that labeling it a stimulus in the traditional economic sense is fully accurate. Look, this isn't new money being created or infused by the government specifically to stimulate a sluggish economy. It is, as the source explicitly puts it, a correction of previous overwithholding.
A correction with a big effect, though.
An effect, yes. But it's money that was always destined for the taxpayer. It was just delayed. While individuals do receive cash, it's merely a delayed payment of what was rightfully theirs all along. It's not an exogenous economic boost from outside the system. Think of it maybe like this. If your bank accidentally overcharges you a fee one month and then refunds it the next, You wouldn't really call that refund a stimulus to your personal finances, would you? It's a correction. And from a macroeconomic perspective, it's more like a redistribution of existing wealth within a short time frame, not the injection of genuinely new capital or demand into the system. And while it does provide liquidity, which is useful, it also implies there was an opportunity cost, right? This capital was held by the government for several months. It could have been put to use elsewhere or perhaps returned earlier, maybe for a smoother, more consistent economic effect over time.
Okay, but regardless of its technical origin, that projected 0.5% GDP boost in Q1 2026, that's a significant, tangible economic benefit. We can't simply explain that away as an accounting quirk. This isn't some minor fluctuation. It's a measurable acceleration in economic activity across the entire country. And think about the broad range of beneficiaries. We talked about from seniors on fixed incomes who can now maybe meet essential needs more easily, to active overtime workers with more disposable income, and even those making significant purchases like cars. It ensures a really wide distribution of this financial relief.
Agreed on the distribution.
Right, so this widespread injection, it can provide critical support for individual finances. It lets people meet immediate needs or make planned expenditures they might have otherwise put off. And furthermore, it gives a pretty robust boost to various sectors of the economy, potentially fostering consumer confidence at a crucial time. This isn't just about individual wallets changing slightly. It's about the collective economic momentum generated by such a widespread and concentrated cash infusion. These are real dollars flowing into businesses, sustaining jobs.
While I absolutely acknowledge the immediate bump in Q1 2026, the numbers suggest it's real, I must press you again on its temporary nature in the larger economic picture. The source itself explicitly warns that refunds will, quote, shrink back down in 2027. That seems pretty clear. It makes it obvious that the higher aggregate refunds are a one-time event, an anomaly directly tied to the legislative timing and those subsequent payroll adjustments. The long-term impact on disposable income isn't a sustained increase in annual benefit, is it? Instead, it's a shift. It's a shift from getting a lump sum refund in one year to getting slightly higher take-home pay distributed throughout the next year. So the economic impact in Q1 2026 might be a peak, sure, but it's arguably a peak built on an artificial surge, one that immediately begins to taper off as withholding adjusts correctly. So relying on the 2026 surge as some kind of predictor of ongoing economic growth or a sustained improvement in individual financial relief, well, that would be inaccurate, wouldn't it? And potentially misleading to both consumers and maybe even policymakers. It kind of sets up an expectation that simply isn't sustainable given the mechanics of the bill itself.
But surely consider the human element here. The immediate experience of getting what feels like a pleasant surprise with a larger refund. That can significantly improve public sentiment and financial well-being, even if temporary. For millions, especially those maybe on fixed incomes or struggling with daily expenses, this unexpected boost provides very tangible relief. It might allow them to catch up on bills, make a necessary purchase they'd deferred, or simply feel a bit more secure for a moment. It's almost like finding an extra $20 in an old jacket pocket. It feels good, it's useful, but you wouldn't necessarily count on finding it again next month, right?
An interesting analogy.
Right. The feeling is real, and the spending that follows is real too. This tangible experience demonstrates, perhaps, the positive impact of tax reform on everyday citizens, genuinely fulfilling that goal of putting more money back in your pocket, as the source suggests. And this positive sentiment in itself can fuel further economic activity and confidence, even if we know the cause is somewhat transient. That psychological boost itself arguably has some economic value.
I'm just not convinced that the potential for a pleasant surprise outweighs the very real risk of subsequent disappointment if those expectations aren't managed properly. Without a clear and frankly consistent understanding that the 2026 surge is, as the source says, artificial and temporary, well, the public could indeed form false expectations. And then when refunds inevitably normalize or shrink back down in 2027, which the source unequivocally states will happen, taxpayers might feel, well, blindsided or perhaps unfairly treated, they could mistakenly believe they're somehow getting ripped off, even though they actually received the very same tax benefit, just delivered differently through higher paychecks spread throughout the year. This highlights, I think, a significant potential for misunderstanding tax policy, and it could ultimately lead to widespread consumer disappointment, maybe even a feeling of having been misled, which could erode the very confidence that the initial surge might have temporarily built. The challenge, surely, for policymakers and communicators is to ensure this short-term boost doesn't completely obscure the long-term reality of how these tax changes actually impact individuals' annual finances.
Okay, so the anticipated tax refund surge in early 2026, the one stemming from the One Big Beautiful Bill, it clearly presents a complex picture. There isn't a simple answer here. On one hand, you have the immediate injection of larger refunds that undeniably provides a tangible financial boost for millions of Americans across various demographics. The broad distribution we discussed and the stated tendency for these funds to be spent suggest a real, if maybe temporary, spur to economic activity. And the direct financial relief for specific groups, seniors, overtime workers, even new car buyers, is certainly a significant positive in the short term. It can foster a sense of financial well-being and create immediate economic momentum.
And yet, on the other hand, the source material also clearly indicates that this surge is largely a one-time phenomenon. It results primarily from that timing difference in tax withholding for the 2025 tax year. And this implies that while the immediate economic effect is real, the impact will normalize in subsequent years. The tax savings will shift from these big lump sum refunds to slightly higher take-home pay throughout the year. Both perspectives, I think, illuminate critical aspects of how legislative changes actually manifest in personal finance and, indeed, the broader economy. It really urges a nuanced understanding of these kinds of shifts. There is certainly more to explore, perhaps, in the material regarding how such significant legislative changes are communicated to the public and what their longer-term effects are on consumer expectations and economic behavior, particularly when you have a short-term anomaly like this involved.